Okay, in chapter 7, we're going to discuss in some very basic, kind of shallow terms, right? We're not going to get into too great a detail how we go about the process of analyzing common stocks. So we have a little bit of road to go here, so let's get started. Essentially, security analysis is really what the meat and potatoes is of investing, right? You need to be able to determine or to create an opinion about what you think is going to happen moving forward, right? So what are the basic principles, right? We need to gather information. We need to be able to put it in some form that we can ultimately evaluate where we think the asset and the value of that asset is going to go. So we need to determine or create something called an intrinsic value, right? What do we think this stock is worth? Now, if you are as they say here, a prudent investor, right? You only buy a stock if its market price is less than what you think it's worth, right? You would never pay more for a stock than the value that you attributed to it. So how do we determine this intrinsic value? We need to know something about the future cash flows of the company. We need to know something about the discount rate, the rate of return that we expect to get from this asset. And of course, in part of that discount rate comes from the riskiness or the risk that we assume or that we analyze or that we perceive is in that particular company and investment. So one of the ways we can analyze this is through something called the top-down approach. And I think, quite frankly, I think this is the most reasonable kind of an approach that is, it's a little bit more scientific, maybe a little bit more academic, but it seems to get us to a point of finding good stocks quicker. So, first thing we need to do is to analyze the economy, right? We need to determine what do we think the economic conditions going to be like in the next 1, 2, 3 years. Given that economic analysis, we need to try to determine which industries will have the best outlook in that economic environment. Once we have analyzed the industry and we have identified the top industries, then we can then go and look at what's referred to as fundamental analysis. If you think about just stocks alone, there are probably 10 to 15,000 different companies that you can invest in. How do you find in that 10 to 15,000, how do you find those stocks that are the best when you have that wide range to look at? So what this economic analysis does is gives us a picture of where we think the world's going to go. Now, given that picture, there will be some industries that do very well and some industries that do very poorly. Well, industries that perform poorly, the reason they're performing poorly is because the companies in those industries are performing poorly. So if we could identify 100 industries to put all of those 10 to 15,000 stocks in, then we can narrow it down and say, well, wait a minute. I want to identify what are the best 5 to 10 industries in this predicted future economic environment. Once I'm down to the 5 to 10 industries, then I can find the best companies in those industries using fundamental analysis. So the idea through the economic and industry analysis is to get our choices down into the 200-300 stocks to look at. Fundamental analysis is still an awful lot of work to do in that process. So let's talk about prices in general, right? And the question we have on this list is, who needs security analysis if we have something called an efficient market? An efficient market basically says that the prices that you see, right, the prices in the stock market are there because they include all the information there is about the stock, so that the intrinsic value and the market value are essentially the same, because all the information we know about the company is there. So fundamental analysis implies then that we can actually find some mispriced stocks. The efficient market says rarely are stocks ever mispriced, and if they are, it's not by very much. So the efficient market says that no security analysis is able to identify those mispriced securities, and the only way you can find those things is through random events. But fundamental analysis is still very important, because we need people looking at companies to make trades so that we can create an efficient market, right? So financial markets might not be perfectly efficient. There are pricing errors that are inevitable, and of course fundamental analysis can help us to seek those things. So let's start with economic analysis, right? How do we analyze the underlying condition of the economy? Well, here's a picture of our economy, of the stock market, of the S&P 500 over the past, it looks like since 1969, obviously, through 2013. And essentially what we're looking at, the blue line here is the S&P 500. And what we're looking at here, these gray bars, represent times of recession. And if you look at this, when the S&P 500 starts to fall down, a recession comes. The S&P 500 starts to trail, so there's a recession, right? Again, there's a recession here. There's a little bit of a recession here. Again, the market falls, there's a recession. The market falls, there's a recession. So the stock market has a tendency to follow the economy. So if we can measure the economy and predict where we think the economy is going to go, we can then predict where we think the stock market is going to go, right? So how can we go about this? Well, let's think about what's referred to as a business cycle, right? It's like a roller coaster. It goes up and down. There are several things that we can measure to help us understand whether it's growing or not growing. So two of those things, one of them is called the gross domestic product. It's the market value of all goods and services produced. So if in the economy we're producing more products and we're doing more services for people, that is an expansionary characteristic. And if we're expanding, that means the stock markets are growing. Likewise, industrial production. Industrial production obviously grows when we make more stuff, right? So normally this GDP, and what's referred to as the index of industrial production, they go up and down with the business cycle. What else can affect the cycle? Other factors. The government can affect the cycle, right? The fiscal policy of the government, right? If the government is taxing us more, they're taking money from us, right? They're putting it into their pockets, if you will. That has an impact on the economy. As the government spends more money, it puts more people to work, right? It's putting money back into the system. How do they manage debt? That debt management, deficits and supplies, right? Currently, we have a huge deficit in our budgeting. Those all have an impact on the economy. The monetary policy, how the Federal Reserve manages our money. They manage the money supply. They have an impact on interest rates. All of these things have impacts on inflation, consumer spending, foreign trade. All of them affect the economy. So how can we ultimately develop an outlook, right? There's lots of places where we can get information. Newspapers, magazines, right? Different kinds of periodicals. But in the end, we basically want to ask a very simple question, right? What industries will be benefit or hurt in a particular economic environment? What focus, right? What should we focus on or avoid with respect to companies in those industries, right? That is the purpose of this economic outlook. So here are some information, just guidelines, if you will, about what we're looking for. Is there real growth in GDP? It's a positive impact. It's good for the marketplace. Industrial production, right? As the economy grows, production is growing. That's good for the market. Inflation is a detriment, right? Corporate profits, profitability in the businesses run. As businesses become more profitable, they invest more. That's good for the market. Unemployment obviously is a detriment. The federal budget, right? Surpluses during strong economic times are pretty positive, right? But modest deficits are not too bad. Currently, though, we have large deficits, right? Again, during downturns, or again, these large deficits could maybe even stimulate the market. They could create some increases. What about the dollar? What about interest rates, right? What about money supply? All of these things have an impact on the economy. It would be nice if we could find a way to measure all this. Could we come up with a number or an index, if you will, that would help us be able to predict this, right? There are things out there that are called leading indicators. Essentially what this is says, look, the stock market or stock prices are a leading indicator in the economy. When stock market prices change, that usually happens before we actually see it in the economy. It happens in the prices first. So the current trend of stock prices is frequently used to predict where the economy itself is going to go. So if you're watching stock prices as well as the economy, sometimes we can make some interesting forecasts about where we should be investing our money. Next, let's talk about industries, right? What can we do with respect to industry analysis, right? We need to look at how they're made up. What are their characteristics, right? What are the variables that drive that industry, right? And of course, even what is the outlook for the industry? What is the life cycle that this industry is in? So we need to establish a few things. Number one, we need to establish the competitive position of an industry, right? What do the competitors within that industry look like, and how does that stack up with respect to other industries? We need to then identify companies in these promising industries, companies within these industries that have some particular promise. We need to find price leaders, right? Those with the largest market shares, economies of scale, etc. So we need to explore these within the industry. So what questions do we want to answer? What's the nature of the industry? What do they do? Is it a regulated or a not so regulated industry? Is labor an important question? Is the labor force unionized or not unionized? Does technology have an impact on the growth or the operations of the company? Are there any other kinds of operating or financial constraints or considerations that we need to know about? All of these questions give us a picture of how well this industry will work once we decide now how the economy is going to work. So we can look at the industry, or we can categorize, industries in a cycle, kind of a pattern, if you will. That when industries are very new, they're very risky, right? We refer to them being an initial development, right? As industries mature, as they start to grow, they get into a phase where now they're in something called rapid expansion, right? The product is going to be accepted by more and more people. Investors are going to become very interested. There's going to be some very high opportunities for profit in investing in these kinds of industries. But eventually we're going to get to a mature growth. That expansion is going to slow, right? It's going to become more stable, right? So the future profit opportunities are not going to be as high as what they used to be. And then finally, we're going to get to a position of stability or decline. So again, we need to understand where the company is. What does the future hold for this industry? Where can we find this information? In our library, we actually have something called the S&P Industry Survey. And if you go to that book, you can find a description for almost any industry you can think of. You can find descriptions of industries. It will look at demand. It will look at the sales. It will look at research and development. It will give you a picture, if you will, of where the industry is today. And now, of course, we have to what? We have to couple that with what we think is going to happen with the economy. Ultimately, we want to identify the 5 to 10 best industries given our forecast of economic growth for the next 5 to 10 years. And that's the end of part 1 for analyzing common stocks.